stocks moved lower on Wall Street following a three-day big rally, what they call it. Stocks fell Friday morning on Wall Street as investors waited for Congress to deliver a big financial rescue package aimed at cushioning ailing businesses and households from the coronavirus crisis. The selling eased some of the market's gains after a strong three-day rally that had the major stock indexes on track for their first weekly gain in 3 weeks. Even after the winning streak this week, the market is still down 25% from the peak it reached a month ago. The S&P 500 was down 3.5% in the morning trading, but is just up to about 10% after the previous week. The benchmark index shot up 17% over the previous 3 days as traders became hopeful that Congress would pass the $2.2 trillion economic aid package. The Dow Jones Industrial Average dropped about 4%, but it is up more than 13% from the last week. European markets also fell. Asian markets closed mostly the highest. The House of Representatives was due to vote on the unprecedented economic rescue package later Friday. The bill, which the Senate passed on Thursday, includes direct payments to households, aid to hard-hit industries like airliners, and support for small businesses. The business shutdowns that have swept across the country forced 3.3 million Americans to apply for unemployment aid last week, which is an historic spike. Investors had appeared to shrug off the miserable news on the unemployment Thursday. Rallies don't last forever, and clearly investors are happy to call time on this one as we head into another uncertain weekend, said Craig Erlam of Oando said in a report. New government data Friday showed U.S. consumer spending inched up about 0.2% last month, matching January's gain. But economists expect spending will be down sharply in coming months, reflecting the impact of the business and shutdown layoffs. The prospect of meaningful financial help to offset the economic damage caused by the coronavirus mitigated some of the concerns about the steep job losses the economy is beginning to see. But barring unexpected good news, it's a matter of time before the stimulus-fueled rally fades, analysts said. Congress's efforts to deliver financial relief for Americans are taking on more urgency as the outbreak continues to widen. The number of cases in the U.S. has now surpassed those in China and Italy, climbing to more than 86,000 known cases, according to Johns Hopkins University. The worldwide total has topped about 550,000, and the death toll has climbed to more than 25,000, while more than 127,000 have recovered. For most people, the new coronavirus causes mild or moderate symptoms such as fever and cough that clear up in 2 to 3 weeks. For some, especially in the older adults and people with existing health problems, it can cause more severe illnesses, including pneumonia or death. Despite strong rallies this week, analysts say further big drops are to be expected until there have been enough sustained gains in the market and progress in fighting the pandemic to ease investors' fear of further declines. Investors have yet to get a clear picture of exactly how badly the crisis has hurt corporate profits. Very few companies have dared to issue forecasts capturing the damage, though traders are just girding for discouraging results in the next few weeks as earnings reporting seasons begin. The losses were widespread on Friday, with cruise lines, hotel operators, and big retailers among the biggest losses. Norwegian Cruise Line, Royal Caribbean, and Carnival led to declines in the S&P 500. The industry has been among the hardest hit by the economic fallout from the coronavirus. The 3 cruise operators are down about 70% and 77% so far this year. In other trading, benchmark U.S. oil was down 6% to $21.30 a barrel. Goldman Sachs has forecasted it will fall well below $20 a barrel in the next 2 months because storage will be filled in the brim, and wells will have to be shut in. The yield on the 10-year Treasury fell to about 0.74% from 0.81 late Thursday. It had been as low as 0.77 just weeks before the job loss was reported. Lower yields reflect dimmer expectations for economic growth and the greater demand for low-risk assets.